Welcome to the first in a series of short courses about the financial statements. This first course is an introduction and overview of financial statements in general. These courses are brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. What are financial statements? Financial statements are reports compiled by businesses that detail a company's financial activities and health. Financial statements provide detailed insights into various aspects of a business. They identify and describe the sources of business revenue, highlighting where the business earns its income. They outline the costs of doing business, helping to understand the expenses involved in operations. Financial statements detail the assets owned and liabilities owed by the business, offering a clear picture of its financial position. Lastly, they show how cash is managed within an organization, ensuring liquidity and financial stability. Why do we need financial statements? They serve as formal records of the financial activities of the organization. Financial statements are essential tools for understanding the financial health and performance of a business. Understanding these documents is essential for making informed business decisions. There are three basic financial statements: the income statement, the balance sheet, and the statement of cash flows. The first statement mentioned, the income statement, is a financial report that shows business income and expenses over a specific time period, like 1 year or 1 month. The key components include a list of sales amounts and income streams, cost of sales, which is a list of the costs associated with the previously listed sources of income, the gross margin, which is the difference between the total sales and the total cost of sales, operating expenses, which are the costs of doing business not directly associated with producing the goods or services, operating income, which is the gross margin less the total operating expenses, a total of all other income and expenses not tied to core operational activities, and finally, the net income or loss that is the result of taking all of the revenue sources and subtracting all of the expenses. Thus, the simplified income statement equation is revenues, also called sales or income, minus expenses equals net income. Another financial statement is the balance sheet, which provides a snapshot of the company's assets, liabilities, and equity at a particular point in time. For example, a balance sheet might be dated June 30th, 2024, or December 31st, 2024. It could be dated anything else as well, March 15th, 2015. It shows the account balances as of a specific date. Key components include assets, which are things the business owns, like cash, inventory, and equipment; liabilities, which are any financial obligations the company owes, like taxes, a loan, or an accounts payable balance; and equity, which is the business value if all assets were sold and all liabilities were paid off. Equity includes things like a business owner's paid-in capital, a company's retained earnings, and net income. A basic accounting equation, sometimes called the accounting equation, is total assets equals the total of liabilities and equity. The meaning of this statement will be explained during the balance sheet course. The next statement we will review is the statement of cash flows, which details company cash inflows and outflows, highlighting how cash is generated and how it is used in 3 different sections. The first section lists cash flows from operating activities, which are the core activities that a business performs to earn revenue. The second section includes cash flows from investing activities, which are activities that involve the purchase or sale of long-term assets and other investments. The final section is cash flows from financing activities, which shows the cash effects of the owners investing in the company, creditors loaning money to the company, and the repayment of both. The cash statement, like the income statement, shows activity during a set time period, like 1 year. Together, these statements offer a comprehensive view of the financial performance and position of the business. These statements will be further explained in future courses. So who uses financial statements? Financial statements are used by every individual and group with an interest in the success of a business. This includes investors, who rely on financial statements to assess the profitability and potential of a business. It also includes financial institutions and lenders, which use these statements to evaluate the creditworthiness and financial stability of a company before extending loans or credit. Accountants, tax professionals, and government agencies, such as the IRS, also need financial statements to ensure compliance with tax laws and regulations. And of course, you, as business owners and managers, use financial statements to make informed decisions, plan for the future, and manage day-to-day operations effectively. Financial statements are vital tools for small business owners for multiple reasons. Analyzing financial statements allows businesses to identify strengths and weaknesses in the financial health of their company and adjust operations accordingly. Financial statements offer insights that help a business plan and strategize for the future. Lenders and investors often require financial statements to evaluate the creditworthiness and potential of a business before providing loans or investment. These statements are also essential for tax reporting and compliance with regulatory requirements, ensuring that businesses meet their legal obligations. Accounting, including the financial statements, can be quite complex, with many different terms and definitions. It's important to note that some terms are used interchangeably, such as revenue, sales, and income. Additionally, financial statements often have various names depending on the source. For example, the income statement is also known as the profit and loss statement, the statement of earnings, the statement of operations, the statement of comprehensive income, and the statement of financial performance. Don't let minor differences in terminology, such as sales versus income, cause confusion. The major structure and contents of each statement will remain the same, regardless of what specific terms are used. Time for a pop quiz. Which of the following is not one of the financial statements? A, the balance sheet. B, the operational efficiency statement. C, the cash flow statement. Or D, the income statement. Financial statements are used by A, investors. B, financial institutions and lenders. C, accountants, tax professionals, and government agencies such as the IRS. Or D, all of the above. Which of the following is correct? A, the balance sheet shows account balances as of a specific date. B, the balance sheet summarizes performance over a period of time. Or C, the balance sheet shows income for a specific date. Or D, the balance sheet looks at cash flow over a period of time. If you need extra time to determine each answer, feel free to pause the video now. We will show the answers in just a few seconds. Here are the answers. Question 1. The operational efficiency statement, while sounding official, is not a financial statement. Question 2. Financial statements are used by all of these groups: investors, financial institutions and lenders, accountants, tax professionals, and government agencies. All these stakeholders use financial statements to make business decisions. And question 3, the answer is A. A balance sheet shows account balances as of a specific date. In our upcoming sessions, we'll dive deeper into several key financial topics. We'll start with the income statement, where we'll explore how to analyze income, expenses, and net income. Next, we'll cover the balance sheet, providing insights into assets, liability, and equity. We'll also examine the cash flow statement, focusing on how cash is generated and used in operating, investing, and financing activities. Understanding the sources and uses of funds will be another topic, helping us identify where funds come from and how they are utilized. We'll then move on to understanding depreciation, exploring different methods and their impacts on financial statements. Financial projections will be covered, teaching us how to create and interpret future financial forecasts. And finally, we'll look at key performance indicators and financial ratios, essential tools for measuring financial health and performance. These topics will equip you with the knowledge and skills needed to effectively manage and analyze your business's financials. Thank you for listening to this presentation brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This institution is an equal opportunity provider.